There we go. Hi, everyone. Today, my guest is Andrew Reynolds, who's written an article for LibertyWorks about Labor's new dividend plan. So the title of the article is Dividend Imputation Credits, How to Send Non-Accountants to Sleep. So first of all, this is a fairly complex issue. I've got an accounting degree myself, and I still get confused by it sometimes. So would you like to first tell us what's Labor's planned, who it's going to impact, and possibly why it's gotten such a big reaction?
Sure. The basics of the plan are that the tax at the moment, company tax that's paid in advance. So company tax that's paid on dividends has franking credits attached, which means when you receive the dividends, it comes also with a little tax bonus saying that on that dividend, 30% tax has been paid. Now, what happens now is that when your taxable income is under $37,000, which is where you hit over 30% tax rate, that amount of dividend dividend paid tax gets refunded to you. If you have zero taxable income, it means that all of that dividend is refunded to you. So the plan is to abolish that, which is the situation as it was prior to 2000 when Peter Costello, as treasurer, brought the tax payments. Brought the money that has been taxed would be repaid to you.
Right. And so my understanding of this issue is that the real issue comes around this definition of taxable income. So there's a lot of poorer people who have this low taxable income, but then there's some arguments that there's a lot of people who have non-taxable income sources that so they're getting this refund. And I guess also the debate around it it comes down to who is the ultimate taxpayer. Is the individual who owns a share, are they the taxpayer, or is the company the taxpayer? So because
I'll answer the first part first, which was, it's true. I mean, the calculation is done on your taxable income.
Yeah.
So if you have a taxable income of zero, then all of the company tax, all of the dividend franking credits, we'll use that term, all of the dividend franking credits will be repaid to you. And you'll get a nice fat check, or more correctly, a EFT payment from the ATO directly back to you. So the difficulty comes where you get a big break between the taxable income and the actual income. So there's many forms of income that are actually exempt from tax. Most pension income is, and most money coming from your super fund is not taxable after you've retired, obviously. So you can have a situation where you have a person that has a very large actual income and a very small or actually zero taxable income. So the issue then comes, well, this person has got a large income, they've retired, it's perfectly legal, it's legitimate. They've got a large actual income on which they're not only not paying tax, but they're getting these tax refunds. And these are the people that Labor is attempting to target. The issue, or at least part of the issue, is that it's a very, very big, a very, very big weapon to try and tackle what is effectively a small potential issue. The people with really large taxable incomes, but no very small taxable incomes, but no actual income.
Yes, yeah. I have heard it argued that that if they really wanted to address that issue, they could just return the 15% on 15% tax back on income leaving the super fund, which was removed more than a decade ago.
Yeah, at the same time that this measure was taken by Peter Costello in 2000. So they could do that. They could do all sorts of things, but what they've elected to do is to say, okay, we'll kill all the refunds.
Yep.
And speaking with a couple of my friends, one of whom who's retired and not on a very big income. I think he's on about $30,000 to $40,000. But a large chunk of that is these tax refunds. And once you're on a pension, even losing $2,000 to $3,000 a year, which a lot of these people are, will be a material impact. You'll notice this.
Yes. Yeah. So, I mean, the fact that they can get this non-taxable income means that someone who's only got enough, investments, enough capital, principal in their super fund to, let's say, earn, I don't know, 50 grand a year. But that would mean that they're able to get the income equivalent of someone who's earning a salary and wage of, I don't know, $80,000 a year or something like that. So if we want people to be self-funded retirees, this seems like a desirable system, and the benefits of saving the taxpayer seems to far exceed any tax they might have paid.
Yeah, it does, and the whole system is built very carefully, and has a lot of thresholds in it. There are a few people who are taking it to a ridiculous extent. There is apparently one person that Labor is making a big fuss about, who's receiving $2.5 million a year in repayments under this system. But the vast bulk of people, the 600,000 plus that are receiving these payments, aren't getting $2.5 million a year out of it. That's one person. So really what they're trying to do is to fix what is a very minor problem with a very big hammer. And they're going to be smashing a lot of people with it to do that.
Yeah, it seems completely miscalculated. I mean, this seems like it could lose Labor the next election.
It could well, and that is something that they're going to have to think about.
Yeah, because I mean, it looked like it's been looking like a sure thing, and this seems to be the biggest stuff up Labor's done in a very long time.
Yes, well, in some parts, I think they were expecting it to be seen as another big tax the rich thing, and they could put it that way. But it's to be frank, it's not going to be. The wealthy people with these sort of share portfolios are very quickly going to be able to rejig them to move them into other asset classes. So they'll just sell the shares, and they won't have the shares. They'll move them into other areas that aren't taxed as heavily. Maybe depending on what they do with housing loans and negative gearing, they might buy houses. If they get taxed on negative gearing, they'll move it somewhere else that isn't as heavily taxed. So it's not going to be the big bonus they're talking about. But what we can be absolutely sure about is the Bill Shorten will decide that it's going to bring in $6.5 billion worth of income, and that he can go out and spend that $6.5 billion. But they're not going to receive it in any case. So to me, it's a huge mistake by them.
Yes, yeah, it comes down to this constant complaining that there's a revenue problem when we know that's not the case. We know that there's just
spending problem,
massive spending problems. I think you touched on this in your article. I might have read this somewhere else. That there's sort of becoming a bit of a sovereign risk issue here with super funds in general. I mean, I remember, when I first started accounting, there was, in the Howard years, super hadn't changed that significantly in a long time. And then the Rudd-Gillard government came in, and then they were talking about super choice and all of these other things. And it just seems that in the last 10 years, superannuations, it especially for younger people, you'd really have to think twice before using that as an investment vehicle at the moment, because it's been shown that you can't rely on the current settings of how super works to be maintained in the future. What would you say to that?
Oh, absolutely. The system at the moment is changing at least twice every year, and in fairly fundamental ways. So it did change reasonably frequently under Howard, but it was only ever in um, only only occasionally, I should say, in any major way.
Mm.
The system, when it was introduced in the mid '80s by under Hawke and Keating, was fairly simple. Money got paid in, the super guarantee got paid in at 50. It was taxed at 15% on the way in. It was taxed at 15% on the way out, and we were done here. It just keeps getting more and more complex. Effectively, the reason I think is that as the super balances get larger and larger, they're an easier and easier targets for governments looking to fill holes in their budget plans. So as they spend more and more, there's this really big pot of money sitting out there that they're very tempted to hit, and every government is now going to be doing it. So to me, I run a self-managed super fund for myself, and I'm a qualified accountant. I work in I don't work in superannuation, but I work in tax and all the rest of it on a regular basis. And all I know about it now is that I need a good tax accountant to do all these calculations for me, because it just changes so often.
Yep.
I'm never going to put any more into it than the bare minimum, because it's just ridiculous that I don't know what's going to happen with it 6, 12, 18, even 10 years from now.
Yeah, I mean, in the last Labor government, they were talking about cracking into super to fund infrastructure projects, and most infrastructure projects in Australia lose money. They're bad investments. So it just really, I mean, for me, there's probably many things before that, but for me, that really made me open my eyes that that it's not this vault that the government can't touch. It's actually it's a superannuation's almost an artificial creation of government policy, and the temptation there, since there's absolutely no desire to do anything about the debt or kick out rent seekers in Canberra, is to raid those funds.
Absolutely, it's over $1 trillion sitting out there, and even if they start nibbling at the edges, 1%, 2%, 3%, that puts a massive great wedge into the budget, and it's one of the things that you just can't run away from. You can't pull it out of super and move it overseas unless you don't intend to come back, and so you're trapped. The money's there, and it's an easy target.
Yes. So So I'm just thinking, what else should we cover on this? So I mean, whether or not someone agrees with this particular change or not, because you could have the view in my that companies pay 30%, and the franking credit system's there to just to make sure you don't pay that twice, but all company profits pay 30%. So if you had that view, then you could argue that this policy's justified. But
the point of the company tax system, and the reason why Keating brought in dividend imputation in the first place, was that they were trying to eliminate the double taxation. So what used to happen was a company made a profit, it was taxed at 30%, and then when it was paid out as dividends, it was then again taxed at your personal marginal tax rate. What the dividend imputation system was designed to do, and does it very well, is to make sure that company profits are only taxed once, and they're taxed at the personal marginal tax rate.
Yeah.
So if a company makes $100 million and pays out 30 million in tax, and the other 70 million, they decide they've got a 100% dividend policy, they pay it away to shareholders, then shareholders receive that, but they only pay tax on that at their personal marginal tax rate. That's the whole idea of the system. Obviously, when dividends are paid overseas, that they go with the franking credits, and unless it's paid out in, I think, New Zealand also has a dividend imputation system, and I believe Malta has as well, but I don't know that there are many Maltese investors in Australia. But it goes with those franking credits. Overseas people, overseas income taxpayers don't get the franking credits back, so that the profits are effectively taxed at 30% to overseas people. But for people who are paying tax in Australia, it's taxed at their personal marginal tax rate. That's the whole idea of the system. What used to happen before Costello's reforms in 2000 was that if your income tax was below 37,000, or at the threshold now, can't remember what it was in 2000.
A lot lower than 37,000.
Yes, it was. But if your personal marginal tax rate was, say, the zero, you're in the tax-free threshold, then you got all of it back. And it may have only been a few $100s at that stage, if you were poor and you had a few shares in BHP. But then what he also did was to get rid of the tax on super payouts, make it completely tax-free, not even taxable income. And so the gap has widened. To me, if you wanted to correct this, what you should be looking at is to set some limits on super fund payouts, so that the really wealthy people getting big incomes out of their superannuation fund, well, most people would look at that and go, well, they're taking the mickey out of the system, so let's do that, rather than just saying we'll use this really blunt hammer to take out the refund of franking credits.
Yeah, stopping the guy who's got the who's a director, who's director of their company, they're very senior in their profession. They're 10 years out from retiring. They're making $1 squillion, and that would be taxed at a very high marginal tax rate. They can put it into super, and with the knowledge that very soon they'll be reaching the age where that they can take it out, having avoided significant amounts of tax. So that's and of course there's no limitations at the moment as to make people take that as an annuity or anything like that, so they can use it to go buy a boat. And so there's lots of things that they could do that would probably improve the super system rather than improve it, erode people's trust in it.
But personally, I think that you should be able to say, well, I put this money in under this regime on this understanding.
Yep.
If they want to change the system after that, that's great, but don't have it affect the decisions I've already made.
Yes. Yeah. That's right.
The really big bonuses that, again, Peter Costello allowed people to put money into their super at, up to $1 million at 15% tax. You may well argue that's unfair or obviously advantaging the rich, and that would be an argument. But then to say, well, you did that under the rules as it was then, what we're going to do is to change the rules to say, well, what you did then was fine, but we're going to hit you anyway.
Yeah.
I think it does introduce those issues of, well, how can we trust anything they say, because they go back and effectively retrospectively change the system. And in many ways, this is a retrospective change to the system, because they went and bought all these shares on that basis. They structure their super fund in that way, and yet they're going to get taxed on the way out anyway.
Yeah. It just goes to show that it's a very complicated system, and any changes that are made to it need to be made with the view of, the intergenerational report kind of view that, how do we get more people to retire, self-funded retiree? Is it being used just as a tax vehicle, or is it being used as a genuine retirement vehicle? These decisions should never be made to recoup a bit of revenue for the current balance of the budget.
Yeah, to me, the system should be a lot more set and forget.
Yes, agree.
This is the way it is. If we get it wrong, then we've got it wrong, and we have to deal with the, if the government gets it wrong, then the government has to deal with the fact that they got it wrong, and work out how to, if they are going to change it, how to change it without affecting the decisions that have already been made. Because from my point of view, as running a self-managed super fund, I have a share portfolio, I have some money in the bank, I've got all of this sort of thing. It's on the advice of my tax advisors, because I know that even as a CPA, these things are beyond me. It's got to be someone who's a specialist in the area. So I've made all these decisions. It's been through, it's correct according to the law, and yet they'll come back later and say, well, we got the settings wrong, we're going to retrospectively reach into your super fund and take the money out of it. And if I've made a decision when I'm about to retire to move everything into shares because those attract a certain tax structuring, well, then that's my decision. I've made it based in good faith, based on the numbers that were there at the time. And then to have an announcement like this makes me think, well, what am I going to do? And worst of all, for Bill Shorten, it means that if I were to think about voting Labor, there's no way I would, because I'd be losing a significant chunk of my income.
Yeah, and I bet there's a lot more blue collar types out there who probably have who have gone and worked for themselves and who are Labor voters and started companies and have taken the advice of their tax accountant and put money into super. Probably a lot more of those than people would think. So
yeah, there's a lot of good Labor men and women who have been working on mine sites or working on the docks or wherever else, who are on some pretty staggering wages now, that would have some significant super balances and be looking at this thinking, well, I'm going to get hit. Do I follow my habit of a lifetime and vote Labor, or because knowing that that's going to cost me a lot of money.
Yeah, well, just one last thing before we wrap up. I'll just ask your opinion on the proposed corporate tax cut. What's your view on that? On lowering it from 30% to I think they're looking at 25, aren't they, at this stage?
Yes. From my point of view, for Australian taxpayers, it makes very little difference.
Yep.
It will increase investment by overseas people in Australia, and it will also mean that they feel a lot better about taking profits out because it'll be taxed at a lower rate. But for Australian personal taxpayers, it won't make much difference. It will, of course, mean that the people who are receiving their dividend imputation credits will receive a lower credit, but then they should also receive higher dividends in the first place. So it'll all come out in the wash for Australian taxpayers. What it will do is mean that foreign investors investing in Australia will have a significant bonus in doing so.
Yeah, and do you think there's much evidence out there that people aren't investing in Australia because of a 30% company tax rate?
Oh yes, a lot of it. The mining companies invest here because it's some of the most mining friendly structures and tax rates in the world, because we can already write off a lot of it against tax anyway. But investing in banks or in other companies here, it is a significant disincentive. Knowing that, for example, if you invest in Ireland, you get 10 to 15%. The US moves its down to 20% shortly. We're going to get whacked.
Right, yeah. So what you're saying, it sounds like it's actually fairly urgent that they do something about this.
Yeah, my personal preference would be to do something like just get rid of company tax altogether. It would make things a lot simpler. There would be no dividend imputation credits. There would be no questions around all of this. All you do is impose a withholding tax on dividends being paid out of the country to foreign companies, and that could be set at whatever rate you want it to. And then you're directly taxing what you want to tax, which is the dividends going overseas, and Australians get taxed at their personal marginal rate on their dividend income. It makes this whole thing a lot simpler.
That sounds a lot. That sounds a lot simpler indeed.
Yes.
Well, we'll wrap it up there. Thank you very much for agreeing to be interviewed, and good work on the article. Yeah. So if anyone's got any experience of this, if you have a share portfolio or a self-managed super fund, and this is affecting you, yeah, please put your comments in below, either on Facebook or YouTube, and we're keen to hear your experience and your thoughts and how it would change, potentially change your vote. Thanks, everyone. Have a good one.
And you.
Yeah.